Folks, you are being played right now. It's always the same game. The power institutional investors are playing you, the retail investors. The pain that you're feeling over the past 5 days is by design. The overreaction that the market is having right now is by design. It is designed to create a false reality of the end of the world scenario where you all sell at the bottom and buy at the top every single time so they can make money. The system has never changed. The markets are always wrong and they're always there to screw with your head.
You've got my blessing to bet on Didi. I would try to get as many shares as you can. DI.
You always buy at the top and sell at the bottom, and it's not your fault. It's because the system is designed to screw you over, and it's happening again. When people were told to buy Nvidia by mainstream media at $950, when people were told that we're going to have 7 rate cuts, that was by design to get you to buy at the top. Right now, they're telling you, oh, we're going to have rate hikes. The rates are going to go up. The world is ending. The World War III is coming. World War IV is coming. Whatever. Space aliens are invading. Everything to get you to sell right now so they can buy at the bottom and ride it all the way up and then do it all over again. Wax on, wax off, like fucking Karate Kid. I'm not gonna let it happen. In this video, I'll show you how the markets are wrong by design to get you to make the wrong move, how every overreaction is by design to get you to absolutely play your hand the wrong way, and I'll show you exactly what's going on, what's the depth of this correction, and how to play it correctly by picking good companies at a discount to ride it on the way up. So is this the end of the bull market as we know it? Or perhaps this is just a breather the market is taking before the next bull run starts. Now, in this video, I'll give you everything you need to know about the situation and I'll answer this question, I promise. Now, the first thing I want you guys to do is zoom out, because when you zoom out, you have better clarity about what you're looking at. Now, if we zoom out over the past 12 months, the S&P 500 is up 20%, even after all this red. The Nasdaq is up 31%. SMCI is up 560%. By the way, those of us who have started buying SMCI back in August of 2023, when I posted my video, we're still up 200% from that point. Nvidia is still up 180% over the past 12 months. Again, Nvidia is a stock we started talking about back in October of 2020. We're still up 450% that one. If you invested in good companies, Nvidia and SMCI over the long haul, not just jumped at the top, you're fine. You're still up a lot. And these zoom outs are important to understand the reality versus the emotions. You see, emotionally speaking, human beings are almost predisposed to feeling more pain. We are way more sensitive to pain than we are to pleasure. So when we see our portfolio up by 10%, we may feel +1 pleasure. But when our portfolio drops by 10%, we feel -2 pain. So the pain is way more felt by investors than the pleasure. And when we have a consecutive week, when everything is just red across the board, it tends to overshadow the reality. So the reality is that things are still up. For the past 12 months, everything is still up. So far, nothing crazy has happened. Now, number 2, you have to understand cyclicality. You have to understand how the market works. Think about it in normal everyday terms. When you want to buy a vehicle, right? You step into a dealership in July, or you step into a dealership late in December. Where is the better deal? You know it's coming late in December because the salespeople, they're way more interested in getting their bonus. They're almost there. Now, same thing with buying a snowmobile. If you want to buy a snowmobile, you probably don't want to buy it in the middle of the winter. If you go into a dealership in July or August, probably going to get a better deal. Same thing. It's all about supply and demand. The quality of the deal you're getting on any product, on any service, on any stock is a direct result of the amount of supply and the amount of demand. That is as simple as that. Now, in the stock market, we can actually measure these things just as we can in real life. For example, a firm by the name of Ranmore Capital, they actually ran a test where they looked at the actual PE of the S&P 500, which essentially takes an average of all the companies in the S&P 500 and it determines the average price to earnings ratio on the index. And what they found that in the 3 years following a measurement, if the PE ratio of the S&P 500 was 25 to 27, you had a very slim chances of making money for the next 3 years. But if the PE ratio of the S&P 500 was 27 and above, you had literally 0% chances of making money for the following 3 years. Now, that data goes all the way back to 1972. That's a really robust data. So basically what it means that if you step into a market for the first time, you have no investments, you just started buying right now when the PE ratio on the S&P 500 is 27. For the next 3 years, you're going to be down. You're not going to be making any money. In fact, you're going to be losing money. And right now, as of today, the average price to earnings ratio on the S&P 500 is, drumroll, 27, literally the point at which it makes it impossible to make any money for the following 3 years. So all the smart money in the market, they realize these things. It's not news to them. So they understand it's not a good time to start buying stocks when the average PE on the S&P 500 is 27. They much rather buy at 23, 22, 21, perhaps even 20. So it shows you a correction is still not completed. And if you look at the overbought, oversold metric of the market, you find out how cyclical the market really is and how it moves in these waves, this serpentine movement. I'll give you an example. Back in April of 2023, we had 4,100 on the S&P 500, and the market was neutral. Then we fast forward to June of 2023, the market jumps to 4,400 on the S&P 500, and we go to extreme overbought. Extreme overbought means we have 2 standard deviations off of the 50-day moving average of the S&P 500. And extreme oversold means 2 standard deviations down. So from April to June, in 2 months, the market jumps almost by 10%, and we go from neutral to extreme overbought. What happens to the stock market when it gets extremely overbought? Well, by October of 2023, within 4 months, the market drops all the way back to 4,100. And then it goes extremely oversold. And what does the market do when it gets extremely oversold? It gets bought again. So from October 2023 until April of 2024, for those 6 months, the market spikes from 4,100 to 5,200 in just 6 months. And we go to extreme overbought territory. Well, borderline extreme overbought territory. Right now, we are at 4,900 on the S&P 500 and the market is neutral. So the history shows us that these cycles, they don't start when the market is neutral. The cycle starts when it's overbought or oversold. The market bounces like a pinball machine every time it gets to one of the edges. So right now, we're neutral. We're not still extreme oversold. When we get to oversold or extreme oversold borderline, that is the time when the market usually starts spinning back. Because at the end of the day, the stock market moves between those 2 boundaries every single time. And look at how quick this happens. Back in March of 2024, 45% of the S&P 500 was overbought and only 15% oversold. Fast forward 1 month, right now, there's 6% of companies overbought and 45% oversold. It completely flipped within a single month. So you can't catch these things. You have to understand cyclicality, and you have to understand that the speed at which the market changes makes it literally impossible to time the market, which is something I've been telling you for a while. So these are not designed to allow you a prediction tool of when to jump on and jump off. They're here to show you that the market has a cyclical nature to it, but look at the numbers. Even though we had ups and downs, look at where we started, look at where we are right now. We started at 4,100, we up, we're down, we're up, we're down. Right now, we're at 4,900 just a year later. So within a year, even though we had all these craziness, we are still up from 41 to 4,900, which means that despite these moves up and down, overall, over the long haul, the market keeps moving up if you invested in the S&P 500 or if you invested in good companies. And if you take a look at this chart, you'll see that the S&P 500 P ratios, price to earnings ratio, completely correlate with the CPI. June 2022, we have 9% inflation, very, very high. What happens to the PE, the price to earnings ratio of the S&P 500? It's at 20. Then on June 2023, 1 year later, when inflation drops from 9 to 3%, the PE ratio, the price to earnings ratio of the S&P 500 rises by 4. But from June 2023 all the way to present time, inflation has not dropped from 3%. In fact, it increased from 3 to 3.5%. But at the same time, what happened to the price to earnings ratio on the S&P 500? It went in the opposite direction. So what the hell is going on in this reversal world? So what happened here? Well, we had a lot of hopium in the market. The market was expecting lots of rate cuts, 6, then 3. Fed was expected to lower rates. Now we know that's not going to happen as fast. We don't know. Maybe we get 1 cut, maybe 2 cuts, maybe even a hike. Nobody knows. There's complete uncertainty and the things aren't as good as they seem just a few months ago. So now the PE ratio on the S&P 500 needs to correct back to the region of 3.5% inflation, which means it has to come down from 27 price to earnings to 24 price to earnings on the entire index. And that means we're not done yet. Which shows you that, number one, you never want to buy a stock that's on its way up, that's flying up like crazy. Because the markets are cyclical. I just showed you. Whenever we are in extreme greed, you don't want to buy the hypey stocks. You want to be very careful. And look at the stock market. It literally bounces up and down between extreme fear and extreme greed. What happens when we get to extreme fear? We always bounce up. It may take a few months, but look at the results. On September 2022, extreme fear hits with 3,600 on the S&P 500. We bounced to 4,000 within 3 months. On March of 2023, same thing. 3,900 on the S&P 500, we bounced to 4,500 on July of 2023 within 4 months. Same thing in October 2023. Extreme fear, 4,200 on the S&P 500, we bounced to 5,200 within 5 months. Absolute insanity. So every time the market goes into extreme fear, that is an opportunity. And if we understand that the market behaves in this cyclical pattern, every time we go to extreme fear, we end up bouncing. Let's look at what's going on right now. And right now, we're simply too hot. Look, we're at 4,900 on the S&P 500, and we're not at extreme fear yet. We're at fear, not extreme fear. Once that happens, and I don't know exactly how soon after that happens, because this is not about timing the market will eventually bounce back up. It's a cyclical movement. But guess what? At the end of the day, in September of 2022, the S&P 500 was at 3,600. That was the benchmark. We went up, we went down, went up, went down. Right now, we're at 4,900. And even if we fall to 4,500, we're still up over the past 2 years. At the end of the day, the index, despite behaving irrationally, radically, volatility, whatever you want to add, it doesn't matter. Long term, the S&P 500 is a cheat code. In fact, we have studies that show that if you stay 15 years or longer in the S&P 500, you're going to beat 90% of institutional investors, which is absolutely insane. And that's the most important thing. Look, if you selected an index like the S&P 500, which essentially is the US economy, if you selected great businesses, it won't matter long term, because long term, these volatility events will be just a blip on the radar. Because at the end of the day, if the stock market always goes up at the end, as long as you invested in an index like the S&P 500, as long as you invested in companies that are great businesses, great cash flow, companies that will be here in 10 years, you'll be fine. Now, you have to understand the difference between price and value. Completely different things. And especially in the stock market, they can be completely disjointed. You can have a great value company and absolutely horrible price, and vice versa. And that's why they say that the best friend of a good business in the stock market is time. Over time, the price will converge with the value. And same goes for bad businesses. Time is their worst enemy, because if they're overhyped right now, that hype will go away. And I want to show an example of that. NVIDIA, great company, rockstar business, $950 per share in the peak. Lots of people bought it. Now they're crying about losing $200 on that share. Now the big question is, for all you dip buyers, is this a good time to buy the dip on NVIDIA at $750? But I don't think that's the right move. I don't think you should be buying right now at $750 and just setting your cost base at $750, hoping for the best. When I posted my first video about NVIDIA back in October of 2020, 4 years ago, our community, discord.gg/TomNash, join for free. Our community was talking about this stock 4 years ago. Most of my community members, they have a cost basis of 170, 200, 250. Some of them have it a little bit higher, but they're up between 200 and 400% on the stock because they've been buying all along this whole crazy cycle. They haven't tried to time the market. And I think that's the right approach. So the real question is NVIDIA a good business? Is NVIDIA a business you want to own? And if so, let's talk about it. So first of all, let me show you the fundamentals. And let's then talk about how to actually get in NVIDIA without timing the market, without overpaying. So looking at NVIDIA right here, revenues are up 125% over the past year. That's a strong performance. Operating expenses are only up 15%. So any company that can give me 125% increase in revenue with only 15% increase in operating expenses, that's good. It's a scalable business. Operating income is up 700%. Cash is up 100%. Free cash flow is up 600%. Net income is up 600%. Total assets are up 60%. Not bad, even the debt is down 7%. The current PE is 63, which is a little bit on the expensive side. But if you look at forward PE, it's trading at sub 25 forward PE. And in my opinion, forward PE is way more credible of a source of a company's true valuation than current PE. So at 24, 25 PE forward, not a bad deal. Now on the price to sales, it is a little bit on the expensive side. But if they keep growing at this pace, that number is going to shrink as well. Now, let's look at NVIDIA, Microsoft, and Google. I think they're good comparables. Look, Google's market cap is $2 trillion. Microsoft is $3 trillion. And NVIDIA is $2 trillion. So three behemoths. massive, massive blue chip companies. So let's go over it. So the first point of comparison is revenue growth. So the revenue growth on NVIDIA side is 125% versus Microsoft 11.5 and Google's 8.7. So it's definitely growing way faster than Microsoft and Google, no doubt. Operating expenses are up 15% over the past year, but if you have a 125% increase in revenues, that's fine. Growth of operating income, Google is up 12%, Microsoft is 21%. Great numbers, by the way, but nowhere near NVIDIA's 680%. They're growing at an insane pace. Net income, 23% growth on Google, 23% growth, 22% growth on Microsoft, 600% for NVIDIA. So the trend continues. Free cash flow up 15%, up 13%, up 600%. So NVIDIA is exponentially, performing better in every category. Cash and investments are down on both companies. It's up 100% on NVIDIA, as you would expect. Total assets are up 60%, which is higher than these two with 10 and 30. Look, at the end of the day, the total debt here is down a little bit, 4% in Google. It's up 50% in Microsoft's case, staggering $60 billion liability. But NVIDIA is dropping its debt by another, 6.7%. Not bad at all. Looking at margins, Google is operating at 27.5% operating margin. Microsoft is way better at 44%. That's great. NVIDIA's margin is 54%. It has better margins than both of these. Price to sales, nowhere near. Look, they're priced to perfection at 31.2. But as I'm saying, this will come down as their growth continues. But right now, they're definitely priced higher on the price to sales. But if you look at forward PE, where I think is the truth lies, you'll find out that forward PE wise, this is the true comparison. So Google is trading at forward PE of 20. Microsoft is at 30. And Microsoft, I agree, should be priced higher than Google in the current situation. But NVIDIA is currently priced right there in the middle. So if you look at forward PE, in my opinion, which is the best category to compare companies, I don't know. NVIDIA seems to be priced better than most companies out there. In fact, they're priced in between Google and Microsoft. And as we just saw here in the numbers, it killed them in every single category. So on the comparison side, I don't have anything bad to say about NVIDIA. We ran a quick DCF here just to show you what is the current price reflecting. So a DCF essentially is just it's a discounted cash flow valuation. So essentially you take all the cash flows from the future, you bring them back to today's value, you add it all up, you add some future growth, and then you get the valuation, right? So what we showed you here is that this number, $760, the current share price factors in this number, 37% EBITDA growth. So the current price of the stock is based on 37% EBITDA growth every single year for the next 5 years. Now, on the 5-year valuation model, we assume the 35% growth on the conservative side, which is just what we saw earlier. And then we said, okay, what happens if NVIDIA grows at 50% a year for the next 5 years? And then give us the kind of the range of where the stock is going to be in 5 years based on this valuation model we got in Stock MVP called the SIF. So based on the most conservative model, we have a 50% upside for the next 5 years, which basically just like a 10-year annual return, something you get on the S&P 500. So that's the floor. So in 5 years, NVIDIA is at least a $1,100 stock. There's no doubt in my mind about that. What happens in the middle ground? Well, that's a $1,700 stock, $1,800 stock. That's a 130% return. But on the 50% growth scenario, if NVIDIA actually grows 50% per year for the next 5 years, that's a $2,400 stock, which means a 220% return on a stock like NVIDIA. I mean, that's very exciting. Now, on the scorecard, this is one of the best companies we have here on the company scorecard here in Stock MVP. Essentially, they kill everything: revenue, net profit margin. It is 10 out of 10. Everything is a 10 out of 10. Assets to liabilities, cash to debt, short interest is very low. Institutional shareholding is high. Everything here is great except the price to earnings. But I just want to show you that the way we score this is if the price to earnings goes below 30, then we give you a 5, and below 10, we'll give you a 10. But it's not going to go below 10, obviously. But as you just saw, the forward PE is actually below 30. So within a few months, within a year, this is going to be a 95 score, not a 90 score. So they are getting better. So I absolutely love this company. So the question here is, well, then in that case, we should buy the dip, right? Well, not necessarily. I don't think you should buy the dip. As I just said, I think you should dollar cost average slowly over time, which means if you look at the stock price right here, you buy 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 at all times. You buy across the entire spectrum of pricing. And then eventually, like we have in our community, your pricing is going to be way, way closer to the bottom than to the top without timing the market. And the way you can do it, essentially, you could decide, well, look, if my price target is $760, so essentially buying more into weakness and buying less into strength, but buying a little bit, tiny bit every single month, every single week, so that over time you have a low cost basis. And here's the trick. If you haven't picked a bad company, if NVIDIA is in fact legitimate and it is a great company, then that is going to guarantee you a very low cost basis in what seems to be a good stock. So that's NVIDIA. But what about the rest of the market, Tom? Well, no problem. Look, at the end of the day, look at the macro picture right now. Strong GDP, strong unemployment numbers. It's still a bull cycle based on the past year. I just showed you this. We have strong earnings, right? It is definitely a needed correction. Don't get me wrong. Obviously, it's needed. It's required. We flew way too close to the sun. But I see this as more of a correction than a total market crash. And I'll tell you why. For a market crash, we need an underlying collapse. We need a recession. We need something in the economy to break is going to lead to a proper crash. I don't think we're there, at least not now. GDP is too strong, unemployment too strong, the economy is just too good, earnings is too strong. It's very hard to see a recession in these circumstances. So if there's no recession, there's no underlying cause for a market crash, this has to be a correction. Now, the fact that it is a correction doesn't mean it's not going to be painful. In fact, it might drop all the way to 4,500, maybe 4,200. So you're looking at a correction between 45 and 4,200 on the S&P 500 before we start the next leg up. It doesn't mean you have to sell out your portfolio. It doesn't mean you have to go 100% cash. It means you have to understand what's the environment we're operating right now. And right now, we are in a correction territory, which means that everybody is extra sensitive. The market is extra sensitive. Investors are extra sensitive. Everything becomes hypersensitive. On top of it, don't forget the unknown unknowns. Things that we don't know about, can't even think about that might come in the future. And even if we talk about the known unknowns, such as inflation, this can be a massive monkey wrench in this market. So we might see a collapse. It hasn't happened yet, but if oil prices shoot up, if geopolitics go crazy, if summer travel sends oil into the stratosphere, if we have Supercore keep flying at 8% annual rate over the past 3 months, if we have rates go up and the entire market takes a dump, yes, in that case, we may see something harsher than just a stock market correction. But guess what? Here's the secret for you. No matter how bad oil or inflation gets, if you bought good companies, and you actually invested over the long haul, creating a base that's not at the peak of the hype, you will be fine over the course of the next 10 years. Now, as always, I want to invite you to join our community over there at patreon.com/Tom Nash. We would love to have you on there. We'll show you how to become a better investor, how to analyze financials, how to do your DCFs. All these things are part of our education system. We'd love to see you there. Also, join our Discord, discord.gg/Tom Nash. We would love to have you there. We talk about inflation, about the market, geopolitics, everything you need to know. It's absolutely free to join. And as always, don't forget to try out Stock MVP. 1 week for free. You can get it right now at stock-mvp.com. Try it out for 1 week for free. If you love it, which I'm sure you will, use the code TOM25 for 25% off for your lifetime of use. Thank you so much. I'll see you in the next one.